During rallies, investors only see opportunities and are blind to the risks. During sell-offs, investors only see risks and are blind to opportunities. Well, the sell-off is finally here, and I'm very happy for that. I have a very long list of stocks that I want to buy, and I've been talking about this for a while, of a potential crash in 2026. I told you guys I'm entering 2026 with 10 to 15% cash. I'm starting to deploy this cash position. The way I normally do it is I start buying a lot of the quality stocks, trading at a discount, mega caps, good companies in general. And if the S&P declines further, like 8, 10, 15%, then I start buying the growth stocks and the speculative stocks and stocks like, Robinhood and just high risk, high reward kind of stocks. So right now I've been buying the quality stocks, and I'm going to share two stocks I've recently purchased in my portfolio, and I really hope you enjoy it as always. The first one is Microsoft. Microsoft sell-off is finally here. It's down 23% over the last 6 months. I've been waiting for this sell-off for a while, and I even called Microsoft at 524. I said the stock barely grew 13%. It's the worst deal amongst big tech. It should be trading much, much lower. Back then, it was trading at 35 times forward earnings. Well, right now, Microsoft is trading at 23 times forward earnings. The bottom tends to be around 21 times. This is what it bottomed back in 2022. It traded as high as 36 times not long ago, and now you could buy Microsoft at 23 times, very close to the 21 PE kind of bottom. To me, the risk reward on Microsoft is getting too good to ignore, and I couldn't ignore it anymore. So I started a small position, and I'm planning to go dollar cost average down. Now, I've been really surprised by the magnitude of the sell-off for Microsoft. But then I noticed there's a very strong correlation between Microsoft stock and IGV. And IGV is a software ETF. And the correlation between Microsoft and IGV is about 89%. So in other words, many investors and the algorithms in general are selling Microsoft, which is a wide moat company with an operating system, and the businesses like LinkedIn and even Xbox and the cloud business in general, which is an amazing business. They're selling it like it's Adobe, like it's some kind of a software as a service stock that's going to be disrupted by AI. And it has an 89% correlation, which makes me feel very good about buying Microsoft, as I believe the sell-off is overdone and it has nothing to do with Microsoft's fundamentals. Now, Microsoft does have some amazing businesses. Azure grew 31%. Microsoft 365 grew 60%. Not bad at all. Gaming declined 9%. It's a little bit cyclical. That's well known. LinkedIn is 11% growth. And I'm always surprised that LinkedIn is a $5.1 billion business. I've just never expected that. If you look at the LinkedIn website, like, how does this website generate $5 billion? It's crazy. Windows and devices, they declined 1%. And everything else, I mean, they did really well. Not bad at all. There's a few reasons why Microsoft has declined. The first one is due to the deceleration in the Azure growth. It went from 40% to 39%, and the guidance is about 37 to 38%. And to me, this is really dumb. Like, do you expect the second largest cloud company, not in the United States, in the world, to keep growing 40% forever? Of course, the growth is going to decelerate 1 or 2%. I mean, it happens. But a lot of the analysts, they're short-term thinking. They believe, oh, it was 40, now it's 39, it could be 37, the quarter after it could be 36, 35. And if it declines to 30%, they will call Azure dead, even though 30% growth for the scale of the business is really amazing. But this is, again, why we have opportunities in the market, is because the analysts, they are rating those stocks. They are short-term thinkers. They only care about this quarter and the next quarter. They don't care about the long-term prospects of the company. The second reason why it has declined is due to the RPO, which is mainly their backlog or future revenues for Microsoft Azure and the cloud business. It jumped from $392 billion to $625 billion. Now, you might say that's really amazing. The only problem is that 45% of the RPO is due to OpenAI. OpenAI is not profitable, and there's a lot of doubts of how can they even get the money of about $250 billion to pay OpenAI and $300 billion to pay, I believe it's Oracle Cloud. They have a $300 billion contract. And how is OpenAI is going to get the money to pay for all those things? So the backlog is not really healthy. And that's why the market took it down. Another reason other than software. But I believe that's really dumb again, because the remaining backlog, which is 65% of it, or about $350 billion, it's growing 28% with companies like Anthropic and other companies in general. Now, I believe OpenAI's 45% share is safe for the next 3 to 5 years. OpenAI is planning an IPO. A lot of companies are still investing in OpenAI. So there's a lot of liquidity coming that should satisfy the obligations for the next 2, 3, 4, 5 years. And meanwhile, the remaining of the backlog, the 65%, it's growing 28% year on year, which is amazing. And 3 to 5 years from now, Microsoft will be able to diversify away further and further from OpenAI. So for me, this is really not a concern at all. And that's why I decided to buy the dip on Microsoft. Now, looking at Microsoft in general, this is really almost a $3 trillion business. And it's still growing 23% earnings per share. This is the third quarter of 23%. And this is adjusted earnings. So after the OpenAI adjusted stuff, it's still growing 23% earnings per share for 3 quarters in a row. Before that was 17%, 14%. That's really impressive, guys. I'm really, really impressed with Microsoft. Now, this is my evaluation model on Microsoft. Now trading at about trailing earnings about 26 times. I'm using 25 times as my base case. I told you guys the stock trades at an average of 29 times. It traded as high as 36 times during peak optimism. And now we're buying it around 23 times forward earnings. Now, looking at this sheet, and I started with 2027 as their fiscal year to get a total of a 5-year estimate. I use 1680, which is the estimate for their 2026 fiscal year, or pretty much this year, which ends very soon. And then I put in 15%. Now, I believe Microsoft could grow 17, 18, 19, maybe even 20% for 1 or 2 more years, but I'm putting in 15% in case the growth decelerates, okay? So those are reasonable numbers. 15% for the next 5 years. The P, I put it at 25 times. It could go back to the average of 29 times, but I'm still using 25 times. In total, I would get $844 per share, or 110% on the upside, or about a 16% annual return on an amazing wide moat company, mega cap stock, with an amazing CEO like Microsoft. Now, I told you guys this multiple could end up trading back at the average of 29 times earnings. And I would not be surprised if it happens. Based on me following the big sevens, they always overreact to the downside. And if you buy them at low multiples, it's really hard to lose money. But if it gets back to 29 times, you're getting almost a 20% annual return. 20%, not with some kind of a small cap like the ones I buy sometimes, but with a big company like Microsoft. Such kind of sell-offs, they don't happen very often. And that's why I'm really excited to talk about Microsoft and potentially buy a little bit more of the stock, and I'm planning to build up the position. And then if you look at the trailing multiple of Microsoft, this is a chart that I found and I can put it up on the screen. It tends to bottom under 25 times trailing earnings. Now trading at about 26 times. I personally believe we're likely near some kind of a bottom on Microsoft, maybe 375, 395. But I did my valuation model and I believed it was too cheap to time or too good to time. So I don't want to try to time the stock or time the market. So I started a small position and I'm planning to build it up, double, triple, and take it to maybe 7-8% of the portfolio. Now, the second one that I bought the dip on recently and I'm planning to buy more is Meta. Meta has been doing really well. It's up about 6% year to date. I bought the dip on the WEF, of the World Economic Forum sell-off, which is about 620, I think 610. It was a good buying dip opportunity. And I believe we're likely going to get more opportunities, and I'm going to be buying more of Meta. I'm going to keep it short on Meta, but Meta did really well on earnings per share. They got 823 versus, they got 888 versus 823. They also beat on revenues, which was really amazing. We look at their total revenue growth, it's still 24%. This is not 24% in earnings, guys. 24% in revenue growth. And this is the third quarter in a row, even more. It's been growing 20% for a while right now. And it has maintained it for far longer than I was expecting. And that's really amazing from a company like Meta. Looking at the daily active people, It's almost 3.6 billion people on the Meta platform every single day. And I always say that it's really underrated because you could buy Meta today for 22, 23 times earnings. And I don't believe that's priced in being able to reach 3.6 billion people. Any kind of apps they decide to launch, maybe the Meta smart glasses or any kind of product, they can advertise it to almost half the entire world for pretty much free. This is crazy, guys. This is amazing value. And it's not being priced in the company at 23 times forward earnings. Now, the good news with Meta is if you look at the Reality Labs have been losing money for a while. They lost 77 billion over the last 5 years in this crazy experiment, which I was not a big fan of. Now, they expect Reality Labs losses to pretty much be similar, and they will likely peak as we start to gradually reduce our losses going forward. So that's really amazing, and the market really liked it as the company is finally starting to focus on profitability, profitable growth. Reality Labs was a money-losing experiment. It didn't work out too well, and they finally want to reduce the losses. So that's really amazing stuff. Now, Meta is one of the few companies of the Big Seven that's actually seeing massive return on its AI investments. I talked about it before, that Meta got back about $60 billion from the $60 billion they invested from when I talked about it before. But even now, this is what they said on the call. They said, we've seen a 30% increase in output per engineer, with the majority of the growth coming from the adoption of agentic coding. And the company is finding a lot of efficiencies, and you're getting the business for about 22 times forward earnings. I started buying at 20. I bought the dip at 19, 20 times earnings. I think anywhere close to 20 or about $625 per share. It gets hard to lose money with Meta over the long term. Even right here, it's not bad at all. But I've been trying to average down. Anytime it hits 20 times earnings, I try to buy the dips. And that's what I'm planning to do with Meta. So I believe Meta is undervalued, but I'm more excited about Microsoft, to be honest. The sell-off on Microsoft doesn't happen very often. And it's selling with the SaaS stock, which to me is really, really funny. But I also have a list of some amazing growth stocks that I'm looking to buy if the sell-off continues in the market. And I share everything I do in my own group. And this is the link if you're interested. But thank you again for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.